All right, guys, welcome back to another video. In this one, we're going to talk about mutual funds and ETFs, or exchange traded funds. Back in the day, right, we're going to go back into history. You could buy a single stock, didn't matter the price, but you had to buy at least one share. Usually they were sold in lots of 100. And so if you had less money, it's very difficult to diversify your investments. You actually have to buy shares of all of these different companies. So you might actually need, several hundred thousands of dollars to actually buy shares, individual shares of all of these companies to diversify your portfolio. So along the way, somebody got the idea and said, hey, you know what? What if we created a fund where we put in a manager, and the manager goes out and buys all of these different companies? Okay, so they buy the individual shares in all of these companies, however they decide to manage it. And then we allow individual investors to come in and purchase a share of that fund. That's when the mutual fund was born. It's a way to diversify. So you might go buy one single share of a mutual fund for $100, and inside that fund is a basket of underlying holdings. So even with one share, $100 share of a mutual fund, you actually have exposure to all of these different companies. You can be very well diversified by just buying a share of a fund. So mutual funds are actually fantastic. They're a great invention and have allowed a lot of people to get access to a lot of different investments they wouldn't have otherwise. Now, for putting this all together and for managing it, they charge a fee, right? Which is reasonable. So they have a fund manager, he has a team or whatever, however it's structured, and they charge a fee to manage it. So ETFs are the same way. A basket of pooled securities. So they go buy a bunch of different stocks, put it all in a basket, and then allow you to purchase a share of that ETF. So in that sense, they're both the same because you're buying a basket of underlying holdings and you're able to diversify with much less capital. Now, let me talk the differences really quick. And in a future video, we're going to look at some of these funds and look at some of these aspects on an actual fund. Mutual funds primarily are actively managed, meaning they have a fund manager that is actively doing research, buying stocks, selling stocks, adjusting the balance of all of the holdings as they see fit to try and manage that fund really well, to try and drive a return. So because they're primarily actively managed, they have higher fees. Somebody's got to pay the fund manager's salary. It's not doing this for free. That fee is incorporated within what's called the expense ratio. And we'll look at funds and show you all of this in detail. So it's an expense ratio. On top of that, there could be sales charges, or loads is what they're called, to actually purchase a mutual fund. So depending on what company can issue it, anybody can create a mutual fund. You have to do all the filings with the SEC. You have to abide by all the regulations, but anybody could start a mutual fund if they wanted and start marketing it. So a lot of that, to get your fund out there to people, right? You go through a broker. So the broker would go out and sell it. He'd earn a commission for selling your mutual fund, right? The fund would pay him a commission. So there are different sales charges or loads that could be there. Now, with more technology and access, those have become few and far between, but they still do pop up from time to time. And sometimes they're still justified. Like if there's a fund that has extremely great performance and they have a great track record, sometimes they can still command a sales charge to be able to sell it. And so as an investor, that just falls on you. Mutual funds in this basket, okay, so let's imagine there's 100 stocks in here. The stocks trade all during the day. Like we talked about with the exchanges, somebody submits an order to buy, somebody submits an order to sell, they meet up and they distribute. That happens instantly all throughout the day. The market hours are 9:30 a.m. to 4 p.m. Eastern time. During that time, the stock market's open, actively trading, all that stuff. At 4 p.m., the market closes. Now there's extended hours a little bit, so some things trade during extended hours, but the bulk of activity happens during market hours and then it closes. So it's not trading all the time constantly. There's a market open and a market close. So what happens with a mutual fund is it does not trade on an exchange daily, okay? What happens is all of the stocks, let's say there's 100 stocks, all of those are trading during the day, and at market close, they stop trading. Then they take the share price, whether the stocks have gone up or down, and they calculate what's called the NAV, the net asset value. So they look at the new value based on the new day of trading, the new value of the stocks, and there could be bond funds as well, but the new value, the market close value of the underlying holding, and they calculate the price per share of the mutual fund. And so then at the end of the day, you can say, oh, my mutual fund was up 1% today, or oh, it was down 1% today. It's based on how those all of the underlying underlying holdings trade during the day. At market close, they take the final value, calculate the net asset value. What that means is that the net asset value of the mutual fund, the share price of the mutual fund, is directly linked with the value of the underlying holding. It is exactly linked to the underlying holding value. Okay, that's important. And then the last thing here, which is a pretty big difference actually, is in how they distribute capital gains and dividends. When you have a lot of people buying shares of mutual funds, the fund has to go out and buy additional shares of stock. When people sell the shares of the mutual fund back to the mutual fund company, then the company goes out and actually sells the underlying holdings to match. So there's buying and selling happening all the time. When there is a sell, like overall, let's say $2 million worth went into the mutual fund, but $3 million came out. So there's a cross of 2 million, but then there's 1 million that actually needs to be sold. So like go out and sell the underlying holdings to raise the $1 million to distribute it. And all those taxes of the capital gains and then dividends from the companies that come into the mutual fund, those are all spread out and distributed to their investors. Even if you buy a mutual fund, you hold it for 10 years, you probably are paying tax every year on capital gains and dividends received within that fund. So tax-wise, it's not particularly efficient. You might not be trading in and out of a mutual fund, but other people influence the amount of taxes paid and distributed across all of the shareholders proportionately. Another important detail there. Okay, so ETFs then. ETFs, I guess I will mention that mutual funds, while primarily actively managed, there are now a lot of mutual funds that are passively managed because they track an index, like we've talked about before. So they started out primarily actively managed. That was their value proposition. We'll have a professional manage this for you, but there are a lot of passively managed mutual funds now. So that's important to know. ETFs, on the other hand, are primarily passively managed. Okay? They primarily do track an index. So fees are extremely low, and that's just how they were built. There are some actively managed ETFs. So that is still a thing. Generally speaking, they're passive. So overall, expenses tend to be lower with an exchange traded fund than with a mutual fund. And there are not really sales loads or charges or commissions for an ETF. There could have been, and sometimes you might find it, but generally speaking, you're not going to see the types of sales loads that you would see with a mutual fund through a broker. Now, as opposed to mutual funds that don't trade minute by minute, you can't, like when you go to buy a mutual fund, you put in the order, I'm going to buy $10,000 of this mutual fund. You don't get it instantly. At the end of the day, market close, underlying holdings are calculated, and they find the NAV of the mutual fund after the market. So you put in an order for $10,000. That is filled at the end of the market when they figured out the new value from the mutual fund, and then what the share price is, and they take your 10,000 and give you the appropriate amount of shares. When you sell, if you put in a sell order, that isn't filled until the end of the day when they've calculated the price of the mutual fund based on that day's trading. So you can't like trade in and out of mutual funds, not quickly anyways. They trade, or redeemed is a better word, once per day at the end of the day, bought or sold. So when you put in an order, it's fulfilled at the end of the day based on the market close of the underlying holdings. ETFs are different. They trade actively just like a stock. So the stock's going all day, the price is changing. You can put in an order, it's fulfilled instantly, and you buy, sell, you can trade in and out. So in that sense, it's very much like a stock. It's like its own little stock, and it's traded actively during the day. Because of that, the NAV of the ETF, the net asset value, right, the share price of the ETF will not necessarily correspond with the value of the underlying holdings. This is really subtle. When you're buying a mutual fund, you are buying the value of those companies. When you buy an ETF, you're buying the value of that ETF, not the underlying holdings. So if there's a lot of demand, a lot of people want to buy the ETF, the price of the ETF per share can go up higher than the actual aggregate of the underlying holdings. So then it's based on supply and demand and how many people want to buy or sell the ETF. Okay, so that's really subtle. Go back and listen to this again if you want to wrap your mind around. But it's important to know it can become detached from the actual value of the underlying holdings, just based on market demand. And then the last thing is on the tax side, ETFs have a special tax treatment. They do not distribute capital gains and dividends out to their shareholders. And so when you buy shares of an ETF, there are no taxes due until you sell those shares of the ETF. Buy and hold it and sell it. When you sell it, then you will realize a capital gain, short-term, long-term, and then pay your taxes. Like I said, with the mutual fund, you can hold your shares, but if other people are redeeming and selling shares, then they're going to pass those gains and dividends on to you, and you can be taxed every year, even if you don't sell your shares of the mutual fund. Okay, those are some of the main differences. So in the next video, I'm just going to walk through and look at some funds, and I'm going to point out the different aspects and how you can kind of begin to sort and see what is out there as far as the funds go. All right, so we'll see you guys in the next video.
Let's keep building your financial foundation.